Hi, this is the spreadsheet extra help file for Chapter 10, Capital Budgeting. So the first thing we want to calculate in capital budgeting is the payback period. So if you have a cash flow of investment of $1,000 in year 0, and these are your cash flows for the next 4 years, how many years will it take you to pay yourself back? So, and what we need is a full year and possibly fractional. So in the first example, we can take the $1,000 and add our first cash flow. So we still haven't paid ourselves back fully. So let's go to the second year, and we'll take and add this to our cash flow. And we still haven't paid ourselves back, but I can tell that we will pay ourselves back in the third year. So what we're going to do is I'm going to put some numbers up here to denote the year. Okay, and then I'm going to see. So this is going to be, I need $100 to pay myself back. So what I'm going to do is I'm going to take the year, and I'm going to add to that minus the residual divided by the next year. So I can get a fractional year, and that's how I get 2.33 years. And we're just going to say years. Okay. So again, what I did was I just figured out the year where the partial payment is going to start in year 3. So that means we have 2 full years. So I added D3 to denote the 2 full years, and I'm doing a fractional part of year 3. So I owe $100, and I'm going to make $300 in year 3. So it's going to take me a third of the year to make that $100, because each third of the year is going to be $100. So that's how we come up with the full year and fractional amount for the payback period. So remember, we're just seeing that, I paid $1,000, made $500, made $400. So now I paid back $900 of the $1,000. I only owe $100. It'll take me a third of the next year to pay myself back $100 if the cash flows are equal. So that's how you calculate the payback year and period. All right. So let's move down to net present value. So here's the net present value. So the formula here is cash flow year 0 plus cash flow year 1 divided by 1 plus k to the number of the year. So we're basically discounting the cash flows here to figure out the net present value. So what we could do is we could discount each of the cash flows and then add them together to get net present value. However, you can also use a net present value formula from Excel. So we can go to formulas, and we can type in net present value, hit OK. We get our net present value formula. So here it's going to ask us the rate. Now, let me just cancel this. I need to write my rate over here. Make this a percentage. Okay, so this way I can calculate it. So I can go back over here. Let's make this a little smaller. Okay. Formulas, sorry, net present value. The rate is 10%. Now, since this is not an annuity, I have to put in each value separately, starting in year 1. And I have to make sure I add at the end, add year 0. Okay, so my net present value was $78.82. Now this would be, you could calculate this also by using this formula, by for each cell, I could take, again, let me put the years up here. I could take cell divided by 1 plus k to the power of the year, and that will discount the cash flow. So if I move this over, we now have to, in the formula, I need to lock down the interest rate. So put some absolutes around that. I can copy this over, and you can see that if I wanted to find, I'm just going to make a negative 1,000 here. Okay, so if I took away this formula and I just found the sum of this, you see I get the same number. So the net present value formula basically essentially discounts all the cash flow for you and calculates the net present value. So you can do it either way. You could use this formula, which means discounting each of the year's cash flows and finding the sum, and that's the net present value. And since net present value is greater than 0, this is an accept. So either way is acceptable. If you want to use the function or if you want to calculate it by adding up all the cash flows, you can do that. Okay, so let's move on to internal rate of return. Let's make this bigger so you can see better. All right. Okay, so here we want to calculate the internal rate of return. So we have our cash flows, and so here is the formula. You see how it's a similar formula to what we used before? So what we want is these cash flows to equal 0. So what we're going to do here is we're going to, so this net present value, we want this to equal 0 is the goal. So calculate internal rate of return, I can again use that function, internal rate of return, and then I just have to highlight the entire range, including year 0, and I will get my internal rate of return percentage. All right. So that's easy enough. And then here we have our mix. And what we're doing here, and for some of these spreadsheets, you can use these to help you do the homework and the test. Okay, so what we have here is we're going to do a try to pick a project based on net present value, using net present value and using internal rate of return for the same amounts. So here again, we could just put in, we can put it on our formula, net present value, select the cash flows. Oops, got to select the rate first. Here's the rate, and then we can, since these are annuity, we can just highlight the cash flows like that, hit OK, and then at the end we have to go back and add the initial cash outflow. And for project B, now project B is a mixed stream, so what we have to do for that is when we go to net present value, we're going to have to put in the rate, and then we have to put each value in independently. Move this down the row. Okay. Hit OK. And again, also with this, we have to go back and add in the year 0. All right. So internal rate of return is actually easier. We can go in and we can function insert, internal rate of return, and here we just have to highlight the information, hit OK, and we get our internal rate of return calculation. And you see down here, I put an if statement in. And I'm saying if B11 is greater than C11, put in B4. If not, put in C4. So I'll put a little if statement to calculate this for me. This should already be there in your spreadsheet. Okay, so that was pretty simple. And now let's go to the mini case. So in the mini case here, let's see, this company, let's make this a little bit bigger. This. Okay. So this company is involved in searching for locations to drill for oil. The firm's current projected requires initial investment. Current project initial investment of $15 million. It has an estimated life of 10 years. The expected cash inflows for the project are shown in the following table. Okay, so here are the cash flows. So answer the following questions, and I put a text box in here so you could just type your answers in here now. And we're looking for calculate project's net present value. Is the project acceptable under the net present value technique? Explain. Okay, so here's the cost of capital. First thing you need to do is calculate the net present value, then calculate in Part B internal rate of return, and in Part C compare and contrast the methods, which do you think is better, and in Part D calculate the payback period. So you have to first make these three calculations and then answer these questions. So not too difficult based on what we learned in the previous sheets. Okay, so that is my quick review on how to fill out and complete the handout, the spreadsheet for Chapter 10. Good luck with this, and I'll see you again soon.